Continue to hear reports of Americans shying away from the stock market out of fear of losing their entire nest egg. But one look at this chart shows the Dow alone has more than doubled in the past 5 years, meaning Americans lost out on an opportunity to double their savings. We are calling in Andrew Keen, president of Keen on the Market, and Alan Nuckman of Trading Advantage to take the fear out of investing. Good morning. And people do have a right to be scared, but is now a good time for someone who doesn't have a dime in stocks to get involved with the stock market?
I don't think it's a good time to get involved in the stock market, but if I currently am with the stock market, there's ways of playing options that I can limit my risk involvement. One of my favorite strategies, if I was long stock, let's say Apple's trading $430, I can buy a zero cost collar. In this situation, I could maybe buy January 2014. I buy the 350 puts, I sell the 500 calls, and I do this for zero premium. So I'm outlaying zero cash for this trade. I'll be stopped on the downside at 350, and I still have all the upside reward up to $500.
But Alan, why not get in the market? People are calling for 1,700 on the S&P 500, for instance.
There's always a good time to get in the market. The markets are never good or bad. You just have to be positioned correctly. But it's all about controlling risk, and I don't think people understand really how to do that. Andrew's talking there about putting in a floor by buying those puts. You can always protect your positions. It's like buying insurance on your house or your car. You have something of value, you want to protect it. That means you have to control risk. And in this day and age, you don't just buy stock shares and put them in a drawer and hope that things are better in 20 years. You have to have a trading plan. You have to have an exit strategy if things go for you, or if they go against you. You have a certain dollar amount you want to risk. It's not all in. You're not putting all of your money into one trade. You need to diversify and put your monies into different baskets with different time horizons.
As Alan said, I'm actually going to agree with him on once. Everything is a risk versus reward setup. I look at every situation as a different setup. How much am I willing to risk on this trade? The difference between a good trader or investor and a great trader, they look at, a good trader looks at how much they can make. A great trader or a great investor looks at how much they can lose.
Let's talk about exit strategies, because people do retire at different times, and the baby boomers are going to be retiring altogether, and they don't want to get out when the market's down. So what should they do?
Well, there are a lot of exchange-traded funds that you can use to track the market itself or different indexes, so you don't have single stock risk that you would have. What you want to do is divide your account into, let's say, 20 slices of pie. So if you lose one slice of pie, it goes completely against you. You still have 95% of your account left. And again, I can't talk enough about maybe buying puts as insurance on any of your positions or your portfolio, and have that protection for 6 months out or 8 months or a year out, so you can sleep at night, and that way you know you've got your downside protected and you've got unlimited upside.
Thank you for the 411, guys. Thanks for coming on the show. We'll see you later this week.
Thank you.